Hello, this is Marie Lundi, your trusted real estate advisor. And so if you're planning to buy a house this year and you're wondering what are your options when it comes to down payments, stick around and let's talk about it. And so before we get started, I want to dispel one of the common real estate myths, which is that a home buyer needs a minimum of 20% as a down payment in order to make a purchase. And so while that is not true, in fact, there are many options available as far as down payments are concerned for home buyers, as low as 3.5% all the way up to 20%. It is important to note, however, the benefits of putting 20% down or more. And so here are a few reasons why putting 20% down is a good plan of action if you can afford it. The first advantage is that your mortgage interest rates may actually be lower by you putting 20% down. And the reason for that is that if you're putting 20% down versus, let's say, 3.5% down, the lender sees your loan as being less of a risk, and the lender also sees you as the borrower being more financially stable. The more confident the lender is with your credit score and your ability to repay the loan, that will translate into you having a lower mortgage interest rate on that loan. Another advantage of putting 20% as a down payment is that you will pay less on your home. And so what I mean by that is by you putting 20% down at the beginning of the transaction, you are paying interest on only 80% of the loan, which translates into paying less for the house. As opposed to if you were to put, let's say, 5% down at the beginning of the transaction, you are now repaying interest on 95% of the loan. Lastly, you won't have to pay PMI. PMI, or private mortgage insurance, is an insurance policy that protects the lender if you are unable to pay your mortgage. It's a monthly fee that is rolled into your mortgage payment, and it is actually a requirement on all of the loans that do not have a 20% down payment. Now, once you build equity of 20% in your home, the PMI is then removed from your mortgage payment. And so as mentioned earlier, when you put less than 20% down, the lender views your loan as more of a risk. And PMI helps the lender recover their investment in the loan in case you were to default on the mortgage. Now, once again, if you're putting a 20% down payment, PMI will not be part of your loan. And so the truth is that there are many programs available to buyers that does not involve putting a 20% down payment. And if you have less than 20% and you want to buy a home, there are many advantages to that, such as you're able to move into a house with less than 20% down and start building equity, right? So that's definitely a plus. However, if you are in a financial position where you do have the 20% as a down payment, you may want to move forward with that sizable down payment for all of the advantages that I just mentioned. And so if you would like to discuss this topic further, or if you're looking for recommendations for loan officers, don't hesitate to contact me. Once again, this is Marie Lundi, here to help.